Hey everyone, it's Daniel here from etfs. Hope you're all doing well. Let's talk about rate cuts. Now, there's all this talk, right, after Powell's meeting and, also a few changes with the Friday's non-farm payrolls, jobs report. You have different pricing that's happening with rate cuts. Now, after Powell's meeting, we did hear Powell kind of signaling a pause, but still opening the door open for possible rate hikes if needed, if warranted, depending on the data, right? And the markets were basically pricing in that June, July, we're gonna get rate cuts for sure, right? On top of that, you're in the midst of a banking crisis that's happening, PacWest, right? Many more other banks that are probably going to go under as well, which basically calls for that some sort of rate cut is needed. Or is it? Or is it completely wrong? Are the markets completely off for pricing in that rate cut, right? The pivot that everybody's expecting. Now, here's the thing. I don't expect rate cuts anytime soon, unless you do get something really bad in the economy that literally happens in the next month or so. But if not, I don't see any chance of any rate cuts coming anytime soon, especially this year. Again, only it would come if there is some sort of something in the economy that breaks. But until then, no, there's no way you're going to get any kind of rate cut from Powell, from the central bank, especially with where we are right now with the data. Now, let's talk about today's jobs data. So I have the jobs data here in front of me. The non-farm payrolls report, the average hourly earnings came in higher than expected, 0.5% versus the expected of 0.3%. You have the headline number, non-farm payrolls number, coming at 253,000, higher than expected of the 180,000. However, the revisions did come in lower. So the number for last month was around 236,000, but it got revised down to 165,000. So you could argue that, hey, that's a very bad number. So, do we ignore the current number? Can we see the revisions next month also show the deterioration of the jobs data, right? So there's some confusion there, which is why, you saw the equity markets bouncing up and down on that number. However, the number did come in stronger for today's report, for the Friday's report, which was 253,000, which is higher than the consensus, right? The participation rate number also a little better. We had the unemployment rate number way better as well, 3.4%. The expectation is 3.6. So here's the thing, right? You're looking at this data and you think you're Jerome Powell, think you're the central bank. You've got a duty, which is to bring inflation down. Yes, you need also jobs to be robust, which it is, right? Look at the report. You look at non-farm payrolls, it looks fine. The unemployment rate completely looks fine. So you can check mark the jobs number, because that you're doing very well, and jobs are completely strong and robust, like we heard from Powell also mentioned that. So, but the inflation is a big problem. So that needs to be solved. So how do you solve that? How do you fix that? Well, if, we're not getting inflation down, and as we heard from Powell in the last Jackson Hole Symposium in August, that pain is expected to come to households and businesses. And in order to get that pain, you need to be aggressive in raising rates or tightening conditions higher for longer, doing QT, keeping rates higher, or maybe even raising rates to even more elevated levels, right? So the jobs data basically suggests that, this rate cut that everybody's trying to predict and price in, forget about it. There's no way that a rate cut is going to come anytime soon, again, unless something is going to completely break, which we don't know what it is. Can it be commercial real estate? Can it be something, in the shadow banking sector, private equity funds, hedge funds, BlackRock, Blackstone? Who could it be? We'll find out. The regional banks, maybe, the big banks. We don't know. What will it be? Will it be Europe? Will it be US? Where will it start? Canada? Who knows, right? But the point is that with these strong numbers, it doesn't give any reason for the Fed to back off on hiking rates or tightening. There's a reason for them to continue to be hawkish. And when you look at the data with what is being priced in terms of rate cuts and rate hikes, the June probability of rate cuts was high, but that has completely changed. And that's now out of the question after the jobs number. So now we're pricing in about a 4% chance of a possibility of a rate hike also in June. Now here's one thing. It's so interesting, right? The June number, and this is going to fluctuate, right? The June number before was not pricing in any rate hike for June. It was 100% we're going to get a pause. Now you got a 4% chance. And this number can definitely change, especially the upcoming data when we get inflation this month and other data points as well. This number can 100% change. The probabilities can 100% change within days, especially if the data continues to come in hotter than expected. Then for sure, right? For sure, you're gonna get more probabilities, more chances of some sort of rate hike to come in for June. So we'll see what happens. Let me know what you guys think. What do you think, we're going to get a rate hike in June or not? Is the Fed going to tighten? Are they not? Are they going to, do you think the rate cuts are going to come? Because this kind of pricing of aggressive rate cuts from the markets is basically saying that, yeah, something is going to break. But if nothing breaks, forget about it. Again, like I said, we're not getting the rate cuts. Anyways, let me know what you guys think. Leave a comment below, subscribe, hit the like button, bell icon to be notified on the next video, and I'll see you guys around. Cheers, bye.